Our next presenter up is Chris Miles. So Chris Miles, let's get you queued up here and joined in. I've known Chris for, oh sheesh, it's been probably 12 going on 15 years. He identifies as an anti-financial advisor. He's going to tell you a little bit about why that is. Um, he understands money. He understands how it works. He understands economies and he also is an entrepreneur. He started businesses. He gets the entrepreneurial spirit. Chris, are you there?
I'm here.
Hey, perfect. All right. Chris, welcome.
Right.
We're glad that you're part of this. So let's
Yeah,
roll right into
same
the
here.
presentation. I wish we had about 3 days to listen, but we've got unfortunately 30 minutes, and you've got lots of podcasts, lots of other learning opportunities that are out there. So definitely look him up on those and continue the journey. But here for the next little bit, we get to learn from you firsthand.
Yeah. Well, do you want me to share my screen or how would you like me to do it?
Yeah,
Or
let's
would you?
do it.
All
Let's,
right. So I promise I'm gonna try to make this good. And just because we're kind of switching gears here a little bit, just because we're talking about money, like he mentioned, I'm the anti-financial advisor, and I'll talk about what that really means. But pretty much, I just think that a lot of the stuff that you're taught by financial advisors is crap, and that's the pretty much the simplest way to put it, right? Good people, good hearts, but at the same time, they're often not really in your best interest. And that if you know what I'm talking about, go ahead and type a Y in the chat just so I know you guys are still here. If you know, like, oh yeah, those financial advisors are out to get my money a lot of times, and although they're good intentioned, they don't, usually are still looking after their own pocketbooks or families and things like that. But I used to be that guy, right? And here's what I'm going to talk about today, just to make sure that you guys, get the best out of what today is I'm going to show you how you can actually store your money where it's getting higher returns than the bank, which most time pays point nothing percent anyways, and still safer than often the banks and stocks. It's tax free, protected from sue happy predators and creditors. In most states, you guys can have millions stored in here, and they cannot touch it. No one can get to it except for the IRS. They can get to anything, but even then, this is still tax free. So in some ways, they can't get to it. This also builds your family's legacy, which I know is part of this whole regenerative summit that we're talking about here. And of course, this can also be a passive income booster that will pay you twice. It'll shave years off your financial goals. So if you guys are interested in how to do that, like hundreds of my clients and I've already done over the last few decades, and even I know Jared's been doing it too, guys, I would say hang in here because it's going to be awesome. All right. Okay, so this is my inspiration here. This is my dad. This is back, as you can see, 94. This is exactly 30 years ago when I was my senior year of high school. And I'll tell you, like my dad, and maybe he's like some of your guys' parents, he taught me to work hard. He told me things like, your word is your bond. Don't ever half a anything, all that kind of stuff. But he also taught me things when it came to money that one, we don't have enough. We can't afford it. Money doesn't grow on trees. And what do you think I am, made of money? I don't know if any of you guys, any of you, the rest of you have been that way, but if you heard that from your parents too, or maybe you even said that to your own kids, type Y for yes, because that was definitely my growing up. It was all about scarcity, never enough money. And even my dad would say, he's like, you know what? My job is going to literally kill me. My dad worked in a blue collar industry that he really, I mean, he already had strokes by his 40s, heart attacks by his 50s. I mean, this guy thought he would be dead. And so my inspiration was when I grew up, I wasn't going to be like that. Right. So I went to college. And of course, as I go to college, I start to realize all professors are just, 9 to 5 or 9 to whatever, broke people like everybody else. And so I decided to go in business. And I thought, well, if I'm going to become a business consultant and help people with business, maybe I should have real life business experience and not just rely on that. So I dropped out of college with one class to go before I got my bachelor's and decided to actually go and find some business to start. And the first one that became intriguing to me was a financial advisor. I know the one I just ripped on, right? The salesman in a suit, AKA, right? And and so I decided to become a financial advisor, thinking, hey, worst case, I learn about money. Best case, maybe I can help my dad get some of his life back because I had heard so long that, just work your tail off, work hard, save lots of money, which is what he taught me to do. He's like the ultra penny pinching saver. If he didn't get good service, he did not just tip, he would steal the salt and pepper shakers off their tables. I mean, that's how cheap my dad was, right? Anyways, I wanted to give him his life back. And so 4 years after being a financial advisor, he says, Chris, are you going to advise me at some point? I sat down with him at his kitchen table out in Oregon, and we were looking at his finances for the very first time ever. And I said, okay, Dad, this is great. I mean, you've stuff money in your 401k, you got your match, you've paid off all your debt, you've been debt free for years. Here's the deal. If you want to retire today, especially after Y2K, hurt you a little bit, you better hope you die in 5 or 6 years, because that's when you're going to run out of money. I said, that's not what I wanted to hear, Chris. What can I do? I don't know. You did everything right from what I teach as a financial advisor. And that's when I realized there was a problem, because it was just a few weeks later, my friends asked me, he's like, well, how many of your clients are financially free? Well, none. They all worry about money. Even if they're retired, they still worry about running out of money too soon. Okay, well, how about this, Chris? How many of you guys as financial advisors are financially free, not off the commissions by selling us this stuff, but actually doing these investments? How many of you guys are actually financially free doing the stuff you've been recommending? And as I was really honest with myself, there's about 100 people in our office. I said, well, none. There's your problem. And that got me on a journey, guys, to look for something else. And of course, when the student's ready, the teacher appears. I started looking into real estate investing. And the next thing you know, later that next year in 2006, when I was 28, almost 29 years old, I was able to retire. And really, that's kind of what I've been teaching people to do, is how to do that. Now, what I'm talking about today is just one strategy. This is not a strategy that will get you financially free by itself. There's a lot of strategies that help you do that. But this is one key strategy that I didn't even know as a financial advisor. In fact, you're going to end up knowing more than a lot of the financial advisors that try to talk to you, or even insurance guys or whoever else, because this is a strategy that works great if you're an investor and or business owner, which I know some of you guys are both. Especially because even if you think you're just in the business, the ranching business or farming business, the thing is this, is that still, despite having that business, you guys a lot of times are investors. You're dealing with these commodity prices. You're worried about, what is it for a calf, right? Like, you're starting to worry about these kind of things. You're in this game every day. And this is a strategy that works great with that. I love this quote by Coach Bear Bryant. Says, offense sells tickets, but defense wins championships. You got to have a good defense to go with a good offense. Tom Brady would not be Tom Brady if he did not have a good offensive line defending him, right? So we got to have both. But the challenges we have going out there today, we got stock markets that are way overinflated, that we are starting to wonder when the bottom's going to drop at some point. You got the government, of course, wants to tax the crap out of us because, now they got $35 trillion plus of debt and growing every single day, and wonder where they're going to get their money, right? They're going to try to get it from us. We got banks failing, and even if it's just a few banks, we start to wonder, well, is that just a few, or could there be more, right? And then even Warren Buffett. Warren Buffett just a few weeks ago just sold off $400 million of his shares in Bank of America. Do you think that Warren Buffett, who's heralded as the greatest investor, sees something coming down the road? Possibly, right? Not to mention we got interest rates are just going Amber Heard crazy right now, right? So it's just insane what we've seen happen just recently. And just so you know, we got guys like I talked about Warren Buffett. He's got almost 300 billion just sitting in cash right now. That's a number reported before he sold off his 400 million of Bank of America shares. So guys, he's got so much going right now, and we're starting to wonder where they do this. Where are banks storing their money? By the way, what I'm talking about today, I actually know people that there are families that own banks that will not save money in their own banks. They refuse to use it, but they'll hold it in these kind of places, just like here, where they'll hold anywhere from at least 10 to 20% of their own cash in these very places I'm talking about. And guys, it's not just banks, it's not even just wealthy people too, guys. This is something that's been used for hundreds of years, even middle class to upper class, everybody's been using this. It's just been kind of distorted because of all the noise lately, especially with social media and everything. But guys like Walt Disney, he actually built this, he actually bought a bunch of swampland using this strategy to create this happiest place on earth in Florida, right? This guy, Ray Kroc, to pay his executives that when he took over, he had to use the same strategy. And this guy, you may or may not recognize him, but you probably recognize his store. During the Great Depression, he even paid his payroll, trying to keep his company afloat during hard times, because this is the only place he was able to get liquid money because he couldn't even trust the banks. Fortunately, 2020, he wasn't so good. Well, he was dead by that point. But by 2020, things were a little bit harder. And so what is that tool that they've all been using for years? It's definitely not the bank, guys. It's right here. And what we refer to in trademark as max ROI, infinite banking. This is a strategy that we've been using for many years ourselves, and so have many other people too. The vehicle you use to do this is you use the most boring thing possible, which is this high cash, low cost, whole life insurance policy. So yes, it's life insurance that actually can store the money, but it's not like the death insurance, which is just an expense. Your term insurance is your death insurance. It's an expense. Whole life is actually an asset that has the death benefit, but most importantly, for the here and now, it's got this tax-free, supercharged, like high yielding savings account that you can actually make a lot of money in, storing your money safely, even safer than what the banks do. And just, a lot of the guys out there, they don't get it, or they see the traditional crap that insurance agents sell you. And of course they're going to rip on it because I do too, but they don't understand it. But there's guys that have, again, made hundreds of millions, if not billions of dollars that have been using this for many years. This guy I had on my podcast, Eddie Wilson. He's actually third generation. His dad was a bank president, was teaching him this very same strategy for himself as he started to try to make his own way and become an entrepreneur. And now this guy's actually sold companies for hundreds of millions of dollars, and he's utilized this strategy all the freaking time. Now, if you guys have ever read this book by Nelson Nash, a lot of people recommend this, Becoming Your Own Banker. This is kind of like the grandfather of the infinite banking concept. Shout out to the Nelson Nash Institute for that too. But this is not the same. And the reason I say it's not the same is because I bought a policy in 2006 after I retired, being a financial advisor and everything. I went into real estate. All these real estate investors were telling me about the strategy. Never heard about it before as a financial advisor. So if you've never heard of it, guess what? I didn't either. And they were telling me like, this is the best thing ever. This is the best way to use instead of using banks. Okay, cool. And I drank the Kool-Aid, took it hook, line, and sinker, and I bought it from a guy. And understand, I had an insurance license, so I wasn't a stranger to how life insurance worked. I just taught people that whole life was a waste of money and a ripoff, But he was showing me how it wasn't. And I asked him, I said, listen, this is pretty expensive in those first years because term insurance gets more expensive each year. Whole life starts out a little bit more expensive, but then gets cheaper each year. So it's front loaded and then gets cheaper, and you have it your whole life. It's something that you don't have to renew. It's protecting you forever. And so I said, well, is there a way to make this cheaper? And he said, no, if you try to change this, you'll be taxed. And of course, like every other good American, I don't like to be taxed, right? Just like you probably. So I said, all right, fine, I'll trust you. Well, 2 years later, 2008, we're getting the depths of the recession. My real estate's having a hard time. I started a brand new business in 2007, marketing towards real estate investors. It was actually that business that I even met Jared in the first place. And we were almost bankrupt by 2008, 2009. I was in the hole. I went from millionaire to upside down millionaire. I was over $1 million in debt. I couldn't keep making these $1,000 a month payments. And so I lost it. There was no money to keep it going. Here's the thing, guys. A couple months later, I found out that this guy that sold me the policy lied to me. I found out I could have actually made it better. In fact, I could have made it so good that even during the recession, I would never have lost it. I put in 25 grand into that policy, and yet I had nothing to show for it. It was like the most expensive ripoff ever. So when Dave Ramsey says a ripoffs, yeah, the one I bought, it was. But when I discovered you could actually do it differently, I actually approached him. I actually slid the office door shut for 2 hours of debating him. And I showed him my own numbers. I said, I ran my own numbers because I had a life license. I said, look, I was able to do the same thing, but better than what you did. And we went back and forth about, why mine wasn't better, whatever. But after I knocked down all his objections, finally, after 2 hours, he admitted to me, he says, Chris, I designed it that way because I could not afford to cut my commissions. I said, there, now we got the truth finally. And by the way, I'm never going to send you a person again. Just so you know, this guy now works for Wells Fargo. So just so you know, people that fail in that industry go work at banks. Another reason why I hate banks, right? But I'm just kidding. Banks are great. I use lots of them. I leverage them, but in my favor, not the other way around. And so anyways, I mean, I vowed it from that point forward. I'm like, we got to change this because people are literally wasting hundreds of thousands, sometimes millions of dollars over their life in these unnecessary fees when you can actually design it better to the point where it actually becomes more like a tax-free savings account versus just an expensive life insurance policy. And that's why a lot of times I'll kind of nickname it no BS infinite banking, right? Is that we don't have to BS you around. You can get the best every time when you do it. Now, here's what the strategy is not for. One, if you're in poor health, maybe you've had a heart attack recently, maybe you've had a brain tumor, something like that, then this probably won't work for you because the costs are going to be so big that savings account is not going to make much money, right? Because all the money is going to go to paying for the cost of the insurance. However, you could do like what one of my other clients did where, he was like 400 pounds. He was in his mid 50s. He said, Chris, I'm pretty sure even if I get approved, it's going to be expensive. He says, but Chris, can I put it on my wife instead? I said, well, tell me about her. Well, she's younger than me. I said, well, that's good. Number one. Oh, and two, she's a woman. Women live longer. So that makes them cheaper already. Even if they're the same age, they're cheaper because of that reason. And then he says, three, yeah, she's in great shape. I said, great, let's do it on her instead. And so he's starting to pack away over $100,000 a year, storing this money away, keeping it safe, making guaranteed money, even when he's had investments fail at different times in his life. And so if you're in bad health, it's not going to work for you, but it could work for somebody else in your family. If you're over the age of 70, this may not be the strategy you want to use. It could work, but you're probably going to look more like estate planning stuff. And of course, if you can't save at least 5 or 10,000 a year, I wouldn't do this strategy. I would just buy cheap term and just, let it be that way. So again, bad health, well into your 70s or 80s, or, if you can't save at least 5,000 a year, then this probably isn't the thing for you. I would just do cheap term until you get better cash flow. But if you're ever anyone else, this works great. Let me break it down what it can do. I already mentioned tax-free, right? This is tax-free now and later, just like a Roth IRA where you use after-tax dollars, you put it in, it grows tax-free, comes out tax-free. It's same exact rules. But here's the great thing, guys. One, if the government ever changes the rules, you have a contract, you're grandfathered in. So even if they change the rules, you're protected, and which they've been talking about doing with Roth IRAs for years now. Two, the other thing that's great too is that, like I mentioned, it's protected from lawsuits and creditors 100% in most states. For those of you in California, sorry, they have partial protection. For the rest of you, it's great. Safer than the bank, as I mentioned. Banks, we have FDIC, but did you know that FDIC only has about 1.5% of savings saved up for us? So if 10% of banks fail, guess who they're running for? They're going to be running right to the Treasury, to the Feds, whatever, saying, can we print more money? And then it becomes like 2020 all over again, where they're saying, hey, we're going to get you money. And then nobody's getting money because they have no money, right? That's what it would be like if we start having big bank failures again, like we had in 2008. The other thing too, is that these guys are protected by insurance companies that guarantee all your money and your death benefit. And again, they rarely fail because they don't take high risk like banks do. Guaranteed growth, usually guarantee at least 3%, but right now they're paying at least 6%. There's no stupid limits or penalties like those Roth IRAs I mentioned. You can only pay in 6,000 or 7,000 a year. Here, you have way more freedom to do a lot more. Bank leverage, I'll talk about that in a second, what that means, but it's pretty cool there. That's what Walt Disney did. Protect your family legacy, but most importantly, it gives you access to cash now. This is money you can actually use for your emergencies. You can use it for whenever you need it in case you need it, right? Now, the best way to fund these, I don't recommend you just throw a bunch of money into it. An insurance agent would love it if you did because they would make big, big commissions off you. Instead, I tell people, let's break it up. So if someone's saying, I can save 20,000 a year, great. Let's put a max contribution limit around 15,000 a year. Someone says to me, hey, I can put in 100,000 a year. Great. Maybe do 80,000 max contribution, knowing that we don't have to do the full 80 or full 15,000 or whatever we set it to be. We can make it whatever we want. So those first 3 years, we break up those payments. We pay it in gradually. We just use your emergency fund. The money that you're not going to invest with or use in your business anyways for emergencies, that's the money we're going to put in, because that money can go right over, transfer over, just like you're trying to transfer to a high yield savings account. Yes, in those first couple of years, there's some initial costs, but as I mentioned, those costs are pretty minimal compared to what you would normally see. For example, year one, only about 20% or so, give or take, might come out in cost. The rest of it's available for you to use whenever you need it. There's no real restrictions. You can actually access it. You don't have to wait a couple of years. Some people will tell you that. Insurance agents say you have to wait 5 years to touch it. That's not the case here. It's 30 days because they want to make sure you're not a terrorist. So they say, wait 30 days. Let's make sure you're not just money laundering, and then we'll let you have access to the money. But after that, you build it up and you can actually use it for your business, for investing, or whatever you want. You can blow it in Vegas. I just don't recommend it. That's not a good way to invest your money, right? Now, I mentioned emergency fund or reserves. So my wife wants to keep 400 grand that we just keep in reserves, don't touch. Well, I can keep it in the bank earning 0.1% at my credit union right now. But you do the math, that's $400 a year, and then I get taxed on that $400. I might, if I'm lucky, walk away with $300 after I pay taxes each year. But I told her, I said, let's earmark 300,000 of the money that we have in our life insurance. We don't touch it. We don't invest it. We just leave it there for emergencies. Because why? Because it's earning almost 6% tax-free right now. And so instead, even if I only earn 5%, right? 5% on $300,000, I'm making 15 grand, not $300, 15 grand. And I still got 100 grand in the bank that if I need to rush to the bank to grab money today. To get the money access, it takes about a week to get this money, give or take, for it to transfer to your account. The cool thing is you can use it as collateral. I actually had a chiropractic client who wanted to buy an office building. But he's like, I might want to buy it in cash. I have this life insurance policy with 300 grand in it. Maybe I should just cash it out and use that. I said, hold on, Sparky, before you just go and jump the gun, let's do this. Let's go talk to your bank and see if they'll use the cash that's in this account as collateral for the loan. Because yes, the building's already the collateral. He wanted to get more extra money for building it out and such. I was like, well, let's use this as double collateral for them. And so what did the bank do? They said, absolutely. We love collateral. We love having cash locked up for us just in case. And so they said, instead of giving you a 5.5 or 6% loan, we're going to give you a 3% loan. And so he was paying $1,800 a month, got the build out and everything done on the building, started renting it out to where the renters paid his entire mortgage payment for him. The cool thing is after a year and a half, when it was all said and done, when everything was built out, he went back to the bank and said, hey, can we take the lien off of my life insurance savings account in here? And they said, yeah, we're good. And we'll keep the interest rate the same. Understand that his payment would have been much higher had he just got a normal mortgage. But he was able to get this low payment, still have it paid for by renters, and he still has that $300,000 do whatever he wants with again. So cool things you can use there for collateral. This is actually what Walt Disney did. It's very well known. And if you ever read his books or his documentaries, he could not get bank funding. They did not believe that Disney would work. So what they do, that he got a home equity line of credit, and then he went and used his life insurance as collateral, not the death benefit, but the cash part of it, the savings part, used as collateral for them to give him the rest of the bank money to create the happiest place on earth. Now, most people tell you it's for extra retirement income. Yes, it could be the tax-free retirement income. And here's a cool thing, guys. I mentioned no stupid limits or penalties. There's no 59 and a half age rule. So where 401ks, IRAs, even Ross will say, we'll penalize you 10% if you try to pull out before you're 60. This does not have any of those rules. So even if you're 30 years old, you could technically retire off of this. Kids savings. A lot of people actually are starting to use this instead of their college savings 529 plans because one, they don't trust the stock market. Even if they have it in the stock market, it usually does worse than the stock market does. Two, the other problem is of course, you never get to pick where it's invested. It's always risky, right? And what if your kid doesn't go to college? What if they decide to become an entrepreneur? What do you do with that money? You got to use it for something that's college related, or they penalize you for your own money. Same thing. What if the kid gets a full ride scholarship and you don't need it? Doesn't matter. If it's not used for college, they will penalize you. So many people are starting to use this as a college savings plan because they can use it for whatever they want. Even if the kid later on decides not to go to college, great. One of the guys on my team, actually, his dad was a very successful business owner, set this up for him when he was a teenager. And even when he went to college, he just went and got tax-free, or sorry, not tax-free, interest-free Stafford student loans. And so the whole time during college, he was letting this build and grow. When he got out of college, his son's like, you know what? Let's not use it to pay for college. Let's use it instead to start a business. And that's what they did, right? And they started a business and making a lot of money there to more than pay off the student loans. So lots of ways to use it that way. Cash flowing investments. I'm going to show you how this works. This is the one thing I've taught Jared as well. It's pretty dang cool. Okay. This is why I call it double arbitrage. Now, if you don't know what arbitrage is, walk into any bank and when you see those boards up on the screens they have there showing all the interest rates, you'll see that they'll show this 5-year CD paying you 3%. And then on the other board, they'll show you a 5-year car loan at 7%. That spread that they make between the 3 and the 7% is not 4% they make. They make more than 100% return because that's more than double the interest. That's arbitrage. You have the ability to do the same thing, but turn the tables and do it back to the bank where you can actually make it. I'm not saying you screw them over, right? Because they know what you're doing, but you can actually get a big advantage over them. Here's the thing, guys. When it comes to money, you can either use cash or you borrow it. That's it. You either pay cash for stuff or you borrow money from somewhere else to be able to pay for it. The thing is, you're always paying interest because even if you pay cash for something, you've actually, guys, here's the deal. Even if you pay interest or even if you've paid cash, you still lost the ability to earn interest of that money. That money is now trapped in whatever you bought. For example, last year, I actually bought a car. I could pay cash for it. But when they offered me a 3.9% bank loan, I said, you know what? I'm actually going to take the bank loan because I know I can make way more than 3.9% with my money. And by the way, I'm going to show you guys how I didn't even have to make 3.9. I just have to make about 2% to beat it. Here's how. All right. Just so you know, this is the concept that will blow your mind. This is one you probably want to see too. So if you're not looking, if you're not much of an Audible learner like I am, I mean, this is something you got to see to believe. Let's say you had a $300,000 mortgage that's at 6%. You're going to pay $347,000 in just interest over those 30 years. Now, some people say just pay extra payments on it, but you really save very little in interest when you pay extra payments on your mortgage. It's It's a big marketing, ploy that they have out there. By the way, I was a mortgage broker. I used to tell people, I used to use this number, the 347,000, to scare people to pay off their mortgage early, which is exactly what the bank wanted. Why? Because the banks love it when you pay off your debt early, because that puts them at less risk and gives them more cash to then reinvest and use to make more interest off of you. That's why they give you a better interest rate on a 15-year mortgage than a 30-year mortgage. That's why they give you a better interest rate on a 3-year car loan versus a 7-year car loan, right? That's why they love it for you to pay off faster, because that's more cash back in their pocket. They are investors. They love it. So that 347,000 interest, the best thing you could possibly do is pay it off from day one with 300,000 bucks. Well, let's just say you had that $300,000, but instead of paying off to say the 347 in 30 years, let's just say instead you just pay your normal 30-year payments, but you take that 300,000 and invest it somewhere else. Well, what if you invest it, and remember at 6% you paid 347,000. What if you earn just say 3% on that money? Guess what? You just earned 428,000 over 30 years on that 300,000 compounding at 3%. You earn 428,000. You're probably wondering, wait, how is that $100,000 more than what I paid? How is that even possible? Compounding interest is different than simple interest. You pay on loans at simple interest. As you pay the loan down, even if you just pay interest only, it doesn't compound against you. It actually gets smaller, not because the banks did this weird formula to rip you off. No, it's just pure math. As you pay the loan balance down, less and less is charging interest because you have less of a balance that they're charging interest on. The interest doesn't change. It's just the amount of interest you're paying goes down as you pay the balance down. Whereas compounding interest is the opposite. It compounds and grows on the way up. That makes sense? All right. So here's what happens if you don't pay it off, guys. At 6%, even if you earn the same interest rate, you earn 1.423 million. Do you think I care about the 347,000 if I can make 1.4 million? 10%, it's almost 5 million, 15, 20, and it gets ridiculous after there, right? It sounds too good to be true, but it's really not. You can do the same thing using this. So instead of just pulling the cash out, which you can withdraw cash from this policy, right? Where you put the money in, it grows that cash after it pays the insurance expenses. It grows the cash inside of there. But instead, we'll borrow the money from the insurance company, borrow from them at an interest rate. You do pay them interest, but they're also paying you interest tax-free. They're paying, like I said, they're paying about 6% a year, while your loan rate's about 6%. What happens is you pay that loan balance down, it goes down, but of course the money they're paying you goes up. And how we pay that loan balance down is we put that into something that cash flows. It pays us more money, whether it's your business. Some people pay their taxes with it and just repay their taxes. They save it back up to do it again each year. Whatever it might be, you're paying it back to get that loan balance down while they still pay you money, because you don't pull the money out. Say you have 100,000 bucks in there, you borrow 50,000 from them, your 100,000 is still in there compounding and growing. But now you got that 50,000, do whatever you want with it. Then you, of course, use that money to pay it back. The money you're earning from it, or whatever you're doing with that money, it pays back. Then that way you're able to make money over here inside the life insurance. You net gain on the interest they're paying you, and you're making money in that investment at the same time, earning money in two places at once. Even use an apartment building, guys, even this example right here, if you use a savings account, you'd earn $1,228 at 0.1% over 9 years after you pay taxes. Using this strategy, 126,000. I actually use my own numbers to ensure that this is true. That's how you make money twice. Now, here's the thing I want you to imagine this, right? And I'm going to skip right to the end, because again, passive income, all this stuff is good, but I want to go back to my dad here. I kind of think of this quote right here: the most dangerous risk of all is the risk of spending your life not doing what you want on the bet you can buy yourself the freedom to do it later, right? That procrastination. Here's the thing, guys, is that what if it could be right now? See, my dad, he did everything he was supposed to do. He did it all right. And the thing is, he's not passing on millions of dollars to us, right? He's 80 years old. We just visited him this last July. This guy's alive, but he's not really living the life that he wanted. He loved to go fishing. He would love to go fishing and do karaoke. By the way, his moniker was Ronnie Cash, because he loved Johnny Cash songs. But of course, as a result, he's homebound at this point. And he tells me, he's like, I don't have this money passed on. In fact, Chris, I don't even understand your life. I'm like, but Dad, you passed on something more important. You passed on a legacy telling me to work hard, that my word is my bond, to don't do anything half-aid, right? Don't do anything that way. Like, always do what you say you're going to do when you say you're going to do it. I'm passing that on to my kids. That's the legacy I want to do. Yeah, I'm building my wealth. And yeah, I can use this tool as well to help pass on this wealth from generation to generation. The key thing is really, guys, it's not just about pass on the money. It's teaching them the very principles that helped you build that wealth. You pass that on to the next generation. That is what works. And it's not just the money, it's the values and everything else that makes this worthwhile. All right. So I'm going to stop that right there, Jared. And
Perfect. Yeah, so
yeah,
I
open up to you.
shared, yep, I shared in the chat and Margot shared, okay, you've got a free gift. So talk um just briefly about what that gift is. People have asked how do we get a hold of them? They've got some more technical questions about their own policies. So I've said, you know, look him up and get a hold of him. It's probably more than we can address right here. So what's your free gift?
Absolutely. So yeah, we're going to offer like an actual consultation, a free consultation to go with that. So because
Oh, that's
everybody
cool.
keeps asking me, they're like, how do I set this up? How does this work for me? What does it look like? We can actually run numbers right with you on Zoom, show it just, exactly what that situation is like. Even if you've got a policy, like many times people say, well, I already have one, but is it any good? We can
Yeah.
actually figure that out for you too.
Okay. Then I think that answers the question. Hopefully it does. Somebody was up there that asked that. So anyway, that book that. Super generous of you for doing that. Thank you for being here with us, Chris. I
Then
feel
such
like
an honor.
this is definitely, it might be like over your head. I get it. It might take, this is going to be recorded. Go back and listen to it. Check out some of his podcasts. And the more you hear it, the more you realize, no, this isn't like smoke and mirrors. This is absolutely legitimate and it does make sense. And as far as building a legacy business, especially for those of us who are higher net worth individuals, this can be a really good tool. So how to be able to build a legacy, this can be a really key part to that. So appreciate it very much, Chris.
Appreciate it as well. Thank you.